Hi, I'm Kim Butler. In this series, we'll be talking about car financing. It's one of the biggest things that people spend money on. It's an important aspect of our lives. At least right now, what we drive really tells a lot about us. And yet, as we go forward, it can be a major expense for our family's economy. You'll want to learn the whole truth behind car buying and car financing. And this video covers it extensively with numbers to prove that 0% is not always 0%.
I mean, think about this just for a minute with automobiles. Logically, you can look at a lot of it and realize there's a problem. If, just thinking about the automobile manufacturing for just a minute, do you think they make more money from the manufacture of automobiles or from the financing of those automobiles? Financing. Everybody knows that, right? So how do they do that at 0%? Volume. Right? That doesn't make any sense. Well, wait a second. If their largest profit is coming from financing, are they really doing that at 0%? No. There's no way. It's impossible. Why wouldn't they just become a bank? Okay, so let's look at this. So the deal with the 0% financing or the 1.9 or whatever the other gimmick is that they have is always based on a rebate somewhere. It may be an unpublished rebate, but there's one there somewhere. Okay? Let's look at one that's actually published. Your option is a $35,000 car with a $4,000 rebate or 0% financing. All right? So I need a payment calculator, Kim. And let's put in minus $35,000 for our loan. We want 0 in the future when it's paid off, a 0 loan rate. And let's do 48 months, monthly and end. And what we see is $729.17 would be the payment on this. Let's take that $729.17 payment, and over here we can put in the payment on this one, yep, on the rate calculator, and take this to monthly and end. Let's put our $35,000 or minus $35,000 present value up there as our loan over 48 months. Okay, so that proved this is a 0% charge coming from the financial institution, correct? All right, now, get me another calculator, Kim, another rate calculator. If I go to my banker, how much do I have to borrow? $31,000, right? Why? Because if I go to my banker, then I get a $4,000 rebate, and I only have to borrow $31,000 for the car instead of the $35,000. Now think about this for a minute. So what you're saying is, the car manufacturer who makes their money off of the interest is going to pay you to take your loan somewhere else. Does that seem logical? Isn't that effect what they're doing? They're going to pay you $4,000 if you don't use their financing, which is where they make all their money. Something's really not quite right there, is it? If my banker charged me the same amount as the car manufacturer is going to charge me, in other words, that $729 payment, monthly and end of period, over 48 months, my banker has to call that 6.08%. Now, why does my banker call that 6.08 for the same payment as the car dealer calls 0? And it's all smoke and mirrors, isn't it? All they've done is add the interest to the price of the car and divided it by the number of months and said they're not charging interest. It's not true. They added it up front. Does that make sense? This is so confusing and such a serious carrot that we've literally had clients that have talked to their banker, found out that their payment with their banker is going to be slightly less, but still opt for that because there must be some magic in the zero. So they're paying more to the car manufacturer than they would have from their banker just because that zero is in their head and that's what they were focused on. So it works. But again, if you think about it logically, was there any way that we really believed that the car manufacturer could have done that at 0% or 1.9 or anywhere else? Mindset. There you go.
Mindset
That's
matters.
exactly right.
Love it.
Yep.
So tell us how we should buy our cars most efficiently. What are the questions we should be asking?
Well, the best thing would be to go and find, you need the cash price first. It's very hard to do this after the fact. So there's a couple of seats up here. So it's very hard to do this after the fact because nobody ever remembers what the price of the car was if they walked out with it. Okay? So what you need to do when you're buying one is to go in and say, I need your bottom line cash price. I don't want your financing. I'm not doing any of that. And understand I'm going down the street and I'm going to talk to your competition. So, what is the bottom line cash walkout price? Once you get that, then you can say, well, what if I do look at your financing? And they're going, wait a second, we can't. we can't do that, okay? Because they're going to have to raise the price of the car to give the zero at that point in time. So it's not going to work. But you've got to have that walkout bottom line price to be able to do any of the analysis to find out what they're really charging and whether it's worth doing it.
I've not saw, I have a lot of people a lot of clients that are buying cars, but there's no rebate published.
That's right, but it's there.
When I bought my last one even, I said, what's my cash price? He's like, same as if you finance it.
That's because they're selling enough cars that they can do it.
He would not release any kind of rebate. It was 0% or same price.
So the question is, how do you get to the rebate number if it's unpublished?
And if they're not going to come off of it, then obviously you wouldn't want to finance it or pay cash, would you? If that's all they're going to do, you'd want to finance it with them at zero, even though it's not zero. They've got the finance charges in there. Okay.
If it actually says it in there, within their loan format, or if there's a rebate.
No, and there's actually more and more of that going on, and I wonder if they've gotten in trouble a little bit for it, maybe. But the truth of the matter is there should be a discount in there, and maybe somebody else, another place would give the discount.
So what other industries do we tend to see this kind of information in?
Well, yeah, they learned that from the furniture industry, I think. They've done that for a long time. We had an interesting guy in our town, furniture salesman, and we were doing some work with, and his slogan was, I tote the note. Okay, and this was 0%, et cetera, et cetera. And he came in and he was actually looking at some numbers, and he said, well, wait a second, this isn't fair. I'm being charged interest on a particular item. And he said, I don't charge my customers interest. We said, you don't? No, I tote the note. It's 0%. Do you have a different price for your cash customers versus your customers that pay it out over time? Well, of course I do. I have to make money. But in his mind, that was still 0%, even though he added the price of the interest to the price of the furniture before he divided it out. Okay, so it's there. All right.
So think about some of the conversations that you have with your friends and your children, because cars and furniture are the first things that people start to buy. And the earlier we can get this kind of knowledge and be aware that we must get clear what the cash price is, if it takes going to another dealership or another store or what have you, if we can get clear what that cash price is, then we're operating with the whole truth, and then we can work backwards. And even though we may not be able to actually calculate what the exact interest rate is, if we can get the true cash price, the bottom line literal cash, then we know the whole truth about it.
Okay. All right. So when we're talking about automobiles, I mean, that's just one expense of a lot of things that we have, and we're going to use that as an expense to take this a little bit further. Something that we hear from a lot of people is if we pay cash, we have no interest cost. That's something that's perpetuated highly with Dave Ramsey as an example and other places. Now, let's look at this. So, let's say that we've got, and this could be any expense, it's just automobiles is a large one for just about everybody. If we have somebody that's got $100,000 in current assets, and let's say this individual is a big saver. They've got $100,000 of current assets, $20,000 of annual savings. Now, they've been told that if they increase their savings by the inflation rate, that will inflation-proof their asset. Is that true? Unfortunately, it's not. Inflation is always working on the large number, the amount of money that we have put away. By inflation increasing the amount of money that we're putting in there each year is not going to be an inflation hedge against that big pile of money that's getting hit with inflation every year.
Do you want to take a look at that?
We could. Let's look at this example just real quick. So if you will get me the cash flow calculator. So let's take $20,000, or let's look over 20 years. So put in 20 years. Let's put a present value of $20,000.
We're looking at inflation. You want 20?
Not there, Kim, on the cash flow. $20,000.
That's what I misheard. You wanted some zeros.
Yeah.
Okay.
All right, so we see a total of $400,000. If we add, say, 5% earnings rate to that, not there. Yeah. We see $694,000. So what we're doing is we're trying to accumulate $694,000 over 20 years and keep it inflation-proof. In other words, after the effects of inflation, we want it to be $694,000. That would mean we had inflation-proofed it, correct? All right. So remember that $694,000, and let's do this. Let's increase our cash flow each year by the inflation rate of 4%. And we see that goes to $970,000. Right? But now we're going to take the present value of that and find out if it's $694. So if we get a present value calculator, we put in the $970. At 4% over 20 years, we see only 442. We're a long way from the 694, aren't we? So it'll help, but it will not solve the problem. Because again, inflation is working on the 694, not just on the $20,000 a year that we're putting in there. That's why inflation is a very devastating tax on who? The people that are saving money or the people that are spending and living check to check? Saving people, unfortunately. The people that are living check to check, does inflation really matter to them? Minimum wage goes up, things go up in the grocery store, we're in the same spot. Who inflation affects are the people that are actually trying to save money, and that's unfortunate. Okay, so let's go back to that. All right, so he is increasing his savings by 4% a year, earning a net 5% over 35 years. All right, and what we see is $3,848,447 at the end of this time frame that he's going to will have accumulated. Now, he goes by a Dave Ramsey Financial Peace University and runs into Dave, and Dave says, you know what? I see that you're paying interest to your banker to buy your cars at 6%. Why in the world would you do that when you have all this cash? Everybody knows if you pay cash, you eliminate the interest cost. Man, this sounds great. Let's see what happens. So these $35,000 cars, I'm buying them every 4 years. And so what we see over here is our account went from $3,848,447 down to $2,947,000, which is a difference of $900,000, and I bought $315,000 worth of cars. Now, wait a second. I paid cash. I should have eliminated an interest cost according to Dave. So why did $315,000 worth of cars cost me $900,000? Lost opportunity. Nelson Nash says it like this: we finance everything we buy. Not some of the things, but everything. If we pay cash, do we still finance what we buy?
Yes.
Yes. We finance it with our future assets. Do we not? So we can either finance it directly with the financial institution in the form of a loan, or we can finance it with our future by paying cash. We may eliminate an interest payment, but not an interest cost. Those are two entirely different things that have been bundled together to mean the same thing, and they are not. We still have an interest cost, even though we don't have an interest payment. I have a friend in Louisiana, and he says it like this: you either pass up interest or you pay up interest. Which did we do? We passed it up, didn't we? Okay. Can anybody tell me what interest rate he financed these automobiles at? Well, that's good English, isn't it? At what interest rate he financed the automobiles?
By paying cash.
By paying cash.
And not financing.
Why? What's the rate? Anybody know? 5. Right. Whatever the net earnings rate is on the account. Right? The account was earning 5%, so his choice of taking money out of that account means he literally financed it at 5%. Would it be better to finance it at 5% instead of 6% with his banker? Maybe. That's the best answer. Probably not, because he doesn't have the education to complete the process. If he does have that, which we'll talk about later, then yes, it would. If he doesn't, then probably not, and this is why. If he had never met Dave, would he have had the $3,848,447? Yeah. Would he have found the money to pay his banker for the car? Yeah. So he would have, even if it wasn't the most efficient way to do it, at the end of the time frame, he would have had the $3,800,000 and the car's paid for. But because he ran into Dave and he felt so good about the magic of not paying any interest and how the stuff was just supposed to flow back to him, it's like, Dave's right. This is really cool. I have more money now. We can go out and eat every single night, not just on Fridays.
Dave says no.
That's what happened to the money. And if we carry this out further, what we see is, are those automobiles going to increase in price? Yeah? So let's put a 4% inflation on them. I don't know, here in Texas we have to pay state sales tax on them at 6.25%. What's that now?
You're talking about future purchase price.
I'm talking about what I'm purchasing the car, what the difference is. Yes, we can trade one in. When we trade one in 4 years, what's it worth? The down payment for the next one, right? So we keep that $35,000 or that difference actually growing over time as far as what our outstanding balance is, right? So now then, do we have to buy insurance in order to drive them? Let's say $2,500 a year. Increasing by 6%. Okay, so now we're down to $1,600,000, long way from the $3,800,000. How many families buy one car every 4 years? Isn't it at least 2? If the kids aren't involved? So let's just push that up to purchase frequency every 2 years. And thanks to Dave, we changed what could have been $3,800,000 down to $125,000. But we feel great about it. We had financial peace, right? And when unfortunately, if we figure this out, when does that happen? Yeah, it happens way down here on the end. It's like something's not not going right. I don't have the amount of money that I thought I was going to have piled up. And it's too late at that point, or more difficult, I should say. So it's very devastating, the impact of this over time. What I said was, if I've got an interest payment, that doesn't mean I have, it's not totally related to the interest cost. How's that? Without an interest payment, I can still have an interest cost. Can I not? Okay. The issue is, what people are saying is, if we eliminate an interest payment, we eliminate an interest cost. No, we don't. The cost stays. We've just eliminated an interest payment. Those are different. They shouldn't be tied together. Interest payment does not necessarily mean interest cost. Or an elimination of that payment does not mean an elimination of interest cost. If I pay cash, I still have an interest cost. Correct?
And go over again, what's the interest cost if you pay cash?
The interest cost is going to be the net of whatever account I took it out of. Yes?
What I tell people to explain this is that we kind of have an obligation to make our money work at its highest efficiency. So wherever we have money, it should be earning interest.
Absolutely.
And when we take money from there to pay cash, we are giving up the interest that we were receiving there.
That's exactly right. Whatever money we have should be earning at our best opportunity, should it not? And think about this. If we've got somebody that's got 18% credit card debt, what does it take to counter 18% credit card debt? What do we have to earn to counter 18% credit card debt? 18% net, right? After taxes. We have to earn 18% net to be awash with having 18% credit card debt, right? So every dollar that I have has the ability to earn 18% net by applying it to that credit card debt, does it not? So until that card debt is gone, I have an opportunity cost literally of 18%. My decision to pay cash for a car really cost me 18%, because if I hadn't done that, that cash could have paid off that credit card debt, could it not? Yes?
So Todd, as your client, I'm not much of a numbers person,
Sure.
and I don't have any debt. And I have $100,000 in the bank, as you know. What are you bottom line telling me what I need to do with what you just showed me? Because you're so smart. Tell me what to do.
So the question is, if I pay cash, I don't have debt, I pay cash for everything, and I have $100,000 in my savings account, what should I do with this $100,000?
Okay. So it's going to depend on what you're earning. So that's all you have is the $100,000. You have no debt. If I'm earning 2% on my $100,000, would I want to have a loan on the other side at 6%? No, it would make more sense for me to apply that 2% to the debt, take the payment that I would have paid on the 6%, and apply that back to my $100,000. Now my $100,000 is going to grow faster than it would have if it had been sitting there at 2%. And it's going to be all the same cost. So it's all going to depend on what we're earning. On the other hand, if I've got an investment and I'm earning 12% on it, would it make sense for me to pay cash when I could get a loan for 6%? Why would I take 12% dollars and pay for something that cost me 6%? We always have a payment. We always have a payment.
But that's the client talking.
You're right. That's exactly right. The issue is we don't want to have a payment, but we always have a payment, one way or the other. If we do it the other way and we take money out of our account and pay for that car, then we need to have a payment to pay that back. Either way, we've got a payment.